Hello and welcome to another lecture of Econ 2301, Principles of Macroeconomics. This lecture covers Chapter 12 of your book, which goes over investments and financial markets. So what we're going to look at first is why people invest, and typically when they invest more, why is that? Obviously, investment is a function of overall GDP, or a variable within the function of overall GDP. If you'll recall, the equation for GDP is Y equals C plus I, and that I is investment plus G, government spending, plus net exports if it's an open economy. What we know is that if we have more investment in the economy, GDP will grow. Well, there's a model called Accelerator theory, and this is a theory of investment that states that current investment spending depends positively on the expected future growth of real GDP. In other words, if the economy is not expected to grow or is on the decline, we're going to see investment tick downward or sharply decrease. And this is because, and it just is common sense, if you think your investment is going to make you money, you're going to invest. And if we feel as though the overall economy, GDP, is going to grow, it's going in a positive direction, you're going to invest in the market. It just makes sense. So what we say is that the more positive the outlook is on future GDP, the more likely we're going to see more investment. What you can see from this graph is the shaded areas, which represent U.S. recessions in the past 40 plus years. And what you can see by this is that anytime we have a recession or a negative downtick in economic growth or a contraction, we see investment as a percentage of GDP decline. And that's because people are pulling out their money or they're not investing as much. And it makes sense. If you have a business that looks like it's growing, hiring more workers, and profits are increasing, more people are going to put money into it. If it's a company that looks like it's on the last leg of its existence and essentially laying off workers, people are going to pull that money out. Well, it's the same with the overall investment in our country. As we see people thinking that the economy is going to turn down or go downward, people start pulling out their investments. Investing is pro-cyclical. In other words, it moves in the same direction as real GDP. This is just common sense. And what it means is that if things are going good, more people are going to invest. Things are going bad, less people are going to invest. There is, however, a problem with the fact that it's pro-cyclical. There's also some benefits with it being pro-cyclical. We have the Multiplier Accelerator model, and this builds upon the Accelerator theory. A model in which downturn in real GDP leads to a sharp fall in investment, which triggers further reductions in GDP. In other words, what it's stating is, and you'll recall that investment is a variable of GDP, and the equation for GDP is Y equals C plus I, investment, plus G, government spending, plus net exports in an open economy. What it's stating is that if GDP is going downward, we're going to see a lot of people pull out their investments, and therefore the lack of investment causes GDP to go down even further. It's a multiplying effect. And as GDP goes down even further, even more people are going to pull out their investment. That's just common sense, but we see this huge impact, this multiplying effect, through really bad downturns in the economy. For instance, I recall in 2007, right after Congress voted against the initial bailout of large banks, the TARP, Troubled Asset Relief Program, the first vote was negative, and a lot of people in the market felt like it was doom and gloom. And even those who were I like to call them the armchair investors, they don't know a whole lot about the overall workings of the market, but they do invest a little bit. It's kind of like the armchair quarterback, people who say they know what should happen with the Cowboys and despise Jerry Jones, etc., but don't really know the inner workings of football and what's going on. But what happened was a lot of these people were scared, and so they pulled out their money. Well, then on top of that, GDP goes down even further, the expected growth goes down even further, and people that are working that don't know anything about the economy and have very little investment, but mainly just have retirement and savings, such as teachers, your mechanics, average workers in the economy. What happens is these people start to see their 401k and savings and retirement reduce drastically, and they pull out their money, which leads to even more decline in GDP. And therefore, we'll have back-to-back quarters of negative GDP growth, which leads to a recession. That is the multiplier accelerator model, kind of summed up in layman's terms. Now, you'll note that we can see this even the other direction. What we can do is turn it on its head, and as the economy grows and people see the growth, more people are going to invest. As more people invest, we see GDP increase. Remember, it's a variable of the function of GDP, and therefore more people on the outside, the fringe, the armchair investors will start to invest, and this influx of money will lead to an increase in overall GDP and job growth. Evaluating the future. Alright, here's a finance term that we like to use in economics. It's present value, the maximum amount a person is willing to pay today in order to receive a payment in the future. What that really is just a fancy way of saying the interest that we want. Essentially, if I'm going to give you $1,000 today, I want more than $1,000 in a year if I wait that long to get my money back. It just makes sense, right? The reason why I want more is because of the opportunity cost, because I could keep that money today and invest it in some way I want, or consume, maximizing my own utility in various ways. For instance, I could buy $1,000 worth of Nike shoes today, whereas if I give you the money for a year, I better be able to buy more than $1,000 worth of Nike shoes at that point, because I want to maximize my own utility. The equation for present value is K divided by 1 plus I to the T, which is the time. So it's your initial investment plus the interest, or I is the interest rate. So it would be 1 plus the interest rate to the time. That's a simple equation to tell you how much, how long it's going to take for that investment to increase. You divide that by the initial investment. You will not need to know this equation per se for the exam. That's just a simple equation if you ever want to figure out what interest rate you possibly would like to have to figure out the present value of what your initial investment's worth. That's a max you're willing to pay in order to receive a payment in the future, is your present value. What I want you to know for the exam is that it's the opportunity cost of what you're going to sacrifice today in order to get something in the future. I'm going to give up my money today, so I better receive more in the future. The present value, the value of today of a given payment in the future, is the max amount a person is willing to pay for that payment. As the interest rate increases, the opportunity cost of your funds also increases. Therefore, you're more likely to invest. You need less money today in order to get the future. That's kind of self-explanatory. What that's saying is that if the interest rate is higher, you're more likely to invest. Typically, what happens, though, as the interest rate goes higher is your risk goes up. Interest rate is also another way of saying risk premium. The higher the risk, the higher the interest rate. As the interest rate decreases, the opportunity cost of your funds also decreases. Therefore, your present value is actually higher. And therefore, your opportunity cost is so much, you're probably going to take that money today. Alright, real versus nominal interest rates. What matters to people is the real value of money or income, the purchasing power, not the face value of money. By now, you should know the difference between nominal and real. We've covered it with GDP, we've covered it with income, and now we're talking about it with interest rates. We've also talked about it with wage. It's the real amount. It's the amount that matters. Nominal doesn't matter at all. Nominal is interest rate quoted in the market. Real interest rate actually takes into effect the inflation rate. You will need to know this equation for the exam. The real rate equals the nominal rate minus inflation rate. So, in other words, if my nominal rate was 2%, let's say I had a savings account at a bank that was paying 2% annually, and the inflation rate, or the cost of living adjustment, was 3% for that particular year, my real rate would actually be negative 1%. There is a good chance, actually, I would say at least 99.99% chance, that I will not invest. The only way that I'm going to invest is if I really care about that particular bank and keeping them in business. But I probably shouldn't. So I want to change that. It's actually a 100% chance that I will not invest. The real rate is something we need to take note of, because sometimes things like T-bills and governmental bonds, those are drawn out over 10, 15 years, and their rates are relatively low, and we're going to look at that in a second why. But because they're relatively low, if inflation increases dramatically, we'd rather have that money available to pay for things rather than get the small interest on that. A better way to look at this, maybe to wrap your mind around the nominal versus real interest rate, is think of it this way. What if you got a raise of 3% at your job? You got a raise of 3%. So that means that you're going to make 3% more that year. But at the same time, you went into a higher tax bracket. And because you went into a higher tax bracket, your actual taxes increased by 4%. So, therefore, that raise was actually a negative impact on your actual income. Your real income decreased. That's a good way to look at real versus nominal interest rates. If you put your money in savings for quite a while and something comes along that's better, then your real interest rate would actually be negative, essentially, theoretically. There are different types of interest investments. Corporate bonds are considered more risky. Those are things by private corporations, or they could be publicly traded, but they're not not-for-profit, public or governmental corporations. They're more risky, and therefore they're going to pay a higher interest rate. Remember just a second ago I talked about putting your savings or your money into governmental bonds or T-bills, such as your local bond at your high school, 'cause oftentimes they have bond elections. Those typically last 10 to 15 years, if not longer, those type of investments, and they don't pay very much, and that's because they're not risky at all. And you might be saying, well, the government doesn't make a profit. Why are they not risky? The thing is, if you have a company that is very profitable, such as BlackBerry, let's just say in 2005, 2006, they're very profitable. They're the only smartphone producer, for the most part, in the United States, and you're starting to see some others like iPhone and Samsung and Droid take effect, but for the most part, BlackBerry is number one as far as smartphones are considered in the industry. And you want to invest in them. Well, the problem comes, and why they are more risky than the government, is if people stop buying BlackBerry, BlackBerry doesn't make any money. When it comes to governmental institutions, it's almost impossible to avoid not paying them some, even if it's an insignificant amount. you're going to pay some type of revenue or tax to that entity. Every time you stop in Levelland, Texas, you are paying a tax which goes to support the local education system, local government, police, things like that. If you own a home there, no matter what, you can't avoid paying some type of tax in order to support your local education, police force, etc. So, because of this A, lack of competition, and B, essential monopoly on overall market share, it's inevitable that you will help the government. And by doing that, it tends to be very, very minimal risk. Now, we can argue whether that's good investment or not. What you can see is that the larger the corporation and the longer they've been around, the less risk that they will have, and therefore they don't pay very high interest rates. Like Microsoft, if they were to have some type of bond issued, the interest rate on their bonds would be very low. They're not going to go out of business. They don't necessarily need the money, and so we don't see high interest rates on their loans or their bonds. This shows you a corporate AAA rating, which is the highest you can get, and the interest rates that they've had over the last 10 years from 2002 to 2010, as well as 6-month treasuries. Now you'll see something with the 6-month treasury here that's really interesting. And remember, this is not a long period of time, so 6-month treasury is not the same as a 10-year government bond, and typically they're a little bit more risky, but they're safe in the sense that you can get out quickly. When the government hit its Great Recession, people stopped investing in the long term and started investing in the short term. And you'll see that from 2007 on, we saw a dramatic drop in 6-month treasuries. This is because they become very, very little risk or less risk comparative to the 10-year note, and that's because of length of time. Alright, this just kind of shows you the neoclassical theory of investment. It's a theory of investment that states that both real interest rates and taxes are important determinants of investment. Therefore, the real interest rate, the higher the interest rate, you're going to invest more, as well as taxes. The lower the taxes, the more you're going to invest. Now, the more you're taxed, the lower the real interest rate is. Investment in the stock market. So, retained earnings, these are corporate earnings that are not paid out as dividends. Well, what's a dividend? A dividend is something that a particular company pays you for holding their stock for a given amount of time, typically 3 months. Now, the reason why they would want to only pay you a dividend if you hold the stock for 3 months is that ensures you are not going to just buy and sell the stock at the point in time of paying a dividend. And the company wants stability, and stability leads to a higher increase in their overall price of stock. And so companies will typically pay some of their profit back to those who are committed to them, essentially, in the form of a dividend. Well, after they pay dividends on their profit, everything left is retained earnings. The higher the retained earnings, the higher the stock typically will be. And typically what we use in finance, and this is not necessarily a term that you need to know for the exam, but it's a good term to know for future if you're going to go in any type of economics or financial industry, is earnings per share. And so what we typically do after we see the retained earnings is we divide that out by the amount of shares a company has, and the higher that is, the more likely we are to invest in that particular company. And that just shows us that they are very profitable and that they're doing things the right way, right? Corporate bond. This is a bond sold by a corporation in order to borrow money. This is public, and therefore anybody can buy it. There is institutional investments, and that's investments with inside the company, but this is something sold to the public so anybody can buy. The Q theory of investment. This is pretty interesting, and it's really common sense, but it's almost sad in a way too. And it states that the higher the stock price, essentially, the higher the investment. It's a theory of investment that links investment spending to stock prices. And a lot of people who, like I said, are armchair investors, they don't look at the financials of companies, and they don't want to spend time analyzing particular companies. And so if they see a company's price go up, they're going to invest. Now, those of you who are smart, you will know that nominal versus real price actually applies. A company can have tons of shares of stock and be worth more at $10 a share than a company with only one share of stock that has a stock price of $1 million. That company is only worth $1 million if they have one share. Whereas a company, let's say like Microsoft, worth billions and billions of dollars, has billions of shares of stock, only worth $20 a share, that means that $20, that one share, is not necessarily reflective of being worth however much less than $1 million per share. It just means that they have more stock out there. It's nominal versus real, comparing the stock price. Well, the Q theory of investment states that you're going to invest the higher the stock price. And so if we see a company that has a share of $1 million, well, that means that they're better than Microsoft, right? It's worth more. So a lot of people invest that way. It's sad, but people typically do that. Price of stock. Present value of expected future dividend payments. That's just a simple way to state that if they're going to pay you back more, the higher the stock price is going to be. If they're not going to pay you anything, the lower the price of stock should be. This kind of just shows you investments and the percentage of share of GDP. And you can see when people started pulling money. And this is actually from 1997 to 2003. Right after 9/11, we see a huge pull off in investment. And I want to say not just 9/11, it was the dot-com bubble as well, when people realized that having a website didn't necessarily translate into profits. I know that a lot of you are young enough that you don't know a life without the internet, but as the internet started booming and people had websites, anybody who had the knowledge of producing a website was given millions of dollars. It turns out that a website in and of itself doesn't translate into profits. Financial intermediaries facilitate investment. What we're going to talk about is how banks work. That's what a financial intermediary is. They're the middleman. The more liquid a particular investment is, the easier it is to take out that money. What happens is the financial intermediaries, they face a higher risk the more liquid the investment is, because you can pull that out at any time. It's like your checking account or savings account. You can go to the ATM and pull that money out anytime, 24 hours a day, typically 7 days a week at most banks. And therefore, they're going to pay very little interest on that because there's so much risk for them. Now, if you face more risk, for instance, you have an investment that's not very liquid, you're going to demand higher interest rates, such as a certificate of deposit. You cannot withdraw that money very easily, and you face a penalty for withdrawing your money before the maturity date of the certificate of deposit. things like bonds, stocks, things like that, you actually have to go and talk to someone physically today. Even if you do it online, there is so much paperwork that you cannot just go and withdraw that money. And so you're going to demand a higher interest rate. There's less risk for the bank, so they're willing to pay you a higher interest rate. Financial intermediaries. I alluded to this just previously. Organizations that receive funds from savers and channel them to investors. Essentially, they're the middleman, and they make money off of that. You know, we talked about the division of labor in the first couple chapters of this class. And the division of labor states that those who specialize will make more money, and we're better off by specializing in trading. A lot of people specialize in being the middleman or channeling investments or money throughout the economy. You give me money, I give it to so-and-so, I lend it out, etc. to investors. It would be very difficult for me to be my own banker. If I did everything in cash, it would be very painful. I wouldn't know how much money I have. It wouldn't be safe in the sense that if I lost my money, then I would be out of luck. It's not insured by anything. So what I like to do, because I am trained as an economics instructor, a teacher, I like to teach. And I trust those who do banking for a living to be my intermediary, and for that I am willing to pay a small fee. And my fee is actually free checking, but I give them my money and they can hold it and invest it however they want. The way banks make money, for instance, and we're going to cover this more in the later chapters, but they take your money and they lend it out to other people and charge them interest. And remember how I talked about liquidity. The more liquid, the lower the interest rate. Well, if you have money in a savings account and that bank isn't paying you much interest, they're not going to lend out very much of that money because it's so easy for you to access. However, if you put money into a certificate of deposit or something that's not very liquid, they're going to take that money and maybe 50 to 60% of it they're going to loan out to someone else in the form of a car loan, a mortgage, a business loan. And by doing that, they're going to charge them an interest rate. And it's going to typically be a lot more than the interest rate they're paying you. Remember, that is their opportunity cost and their risk. And so what they're looking at is to make profit from that. And now, you might say, well, how do banks do that? If I put my money in a certificate of deposit, anytime I can take it out, how can they just lend that money? Well, what they do is on a grand level, they do have some capital reserves, and we're going to look at this more in the future. What they're doing is they're lending out a high percentage relative to each consumer, but overall a low percentage. So there's enough money to cover average Joe. However, if all of the average Joes that invest at that bank or put money into that bank withdraw at one time, they're out of luck. Securitization, the practice of purchasing loans and repackaging them and selling them to financial markets. What they do is they take loans, they divide them up into small pieces, and then they put them all together again, those small pieces. And I'm going to try to make a whiteboard video on this, specifically about mortgage-backed securities. What happens if I take up a mortgage or split up a mortgage and securitize it and repackage it? I'm lowering the risk. If I have one big mortgage, let's just say we're going to use mortgage as an investment tool, and one person defaults on that mortgage, the whole investment goes bad. However, if I take that mortgage that might be risky and divide it up into 100 little pieces and then take 100 pieces from all different mortgages and make a new investment, if one person defaults, that's only 1% of the whole investment tool. Like I said, I'm going to record a whiteboard video, which should illustrate the problems and the good things about the securitization model, and also how it put our economy at risk in the Great Recession. Leverage. This also was something that was very risky in the Great Recession. This is using borrowed funds to purchase assets. Now, this is great if it's just a typical business loan, right? If I were to borrow money to start a taco stand, let's say it's Tom's Tacos, I have a little taco / burrito stand. The money that I borrow from the bank goes to buy the asset of the taco stand. Now, let's say I do it a little bit different. And instead of buying a taco stand, I take money that I borrow from a bank, a loan, and buy shares of ownership in a taco stand. So I don't actually own the physical taco stand anymore. I just own stock or shares of this particular company. My ownership is an asset. However, that asset can change depending on the profit of the company and the solvency of the company. Now, if Tom's Tacos fails and I borrowed against the actual taco stand, the bank can come and repossess the taco stand. However, if I've only borrowed against ownership in the taco stand, then the bank can only take the stock, right? And therefore, there's a lot more risk if the bank loans out for investment assets than typical physical assets that can be repossessed. A bank run. This is panic among investors in which they simultaneously withdraw all their funds from a bank that they feel is going to fail or collapse. Now, remember I talked earlier about how banks make money, and I'm going to talk more about that in coming chapters. But if I'm just average Joe and I want to withdraw my money, the bank has enough reserve capital money to pay me my liquid investment or my savings account / checking account if I want to withdraw that at any time. That's okay, right? What if everybody who's banks at a particular bank withdrew their money? Well, that bank would no longer have the money available to pay everybody because they do lend out some of that money. They make money by making loans. And when we see banks start to fail or they're unprofitable and start declining as far as overall worth, we see a lot of people get panicked and they're worried about their money, right? And so they quickly withdraw their money. Well, this leads to a multiplier effect, essentially, in which the bank can no longer make payments, they can't pay their staff, they don't have any capital reserves. So in order to make us less panicked, in the, I believe, late 30s, we established the FDIC insurance program. Recently, within the last 2 years, we raised the Federal Deposit Insurance Corporation amount of insurance on each investment to $250,000. What this does is it's federal government insurance on deposits in banks and savings and loans, in which if your particular checking account or savings account is worthless because a bank fails, you still get $250,000, or up to $250,000. I should rephrase that. So if I have $1,000 and my bank fails, goes under, I get that $1,000 back because it's backed by the FDIC insurance program. Now, that gives me assurance and a peace of mind, so I don't get panicked and withdraw my money, i.e. the bank run example. Now, why is it $250,000? Well, that's just an amount that Congress has set. What's kind of funny to me, the best argument that I've heard for why it's $250,000 is that worst case scenario, you should be able to live on $250,000. So if you have $1 million in a bank and the bank fails, the insurance program allows you to have $250,000 from the federal government. You can live. Now, the way that we build up this insurance pool, it's essentially the same as any insurance program, each bank pays a fee to the federal government. Now, if all banks failed at one time, we wouldn't be able to cover the amount insured by the FDIC program. Hence why, and for other reasons too, bank bailouts. Alright, I hope you enjoyed this lecture. Like I said, I'm going to put a whiteboard lecture up to explain some of the securitization workings and the way investments work within our economy, as well as what led up to the Great Recession. As always, you can email me at jkemper@southplainscollege.edu. You can also find me at Twitter at Mr. Kemper. I forgot I changed it. At Mr. Kemper, MrKemper. Thank you and have a nice day.